Hey, what's up, guys? Crypto Wolf here, or back again another day. So, we're going to be talking about a few trades, and I'm going to be showing you my strategy and walk you through it, how it goes. So, yesterday, I think after the live, I took a trade here, took a trade here. You could see the marker on it. I took a trade at this point. You could see. So I took a trade was it at this point? No, I don't think it's at this point. Yeah, at this point. That's after the live stream. So took a trade at this point, got in. My target was around 79k, and unfortunately it got to about 78k, and I got in here at around 77,207, but price got to 78,045. I was expecting to get here. It didn't. It just reversed and stopped us out here at 76,849. So, and I took another one. I took another one today at 77,244.6, and unfortunately this was my own error. I will show you the two errors that were made, um, and how to adjust them. First, normally you're supposed to use an engulfing candle, a bullish engulfing, and this was what was done yesterday. I'm just showing you what happened. So it was a bullish engulfing taken from this point up to this point. This was the last swing high. This was the last swing high. So I entered at wanted to enter at POC at 77,208, around that area. So because normally it would have a little bit of variation in execution, but normally based on my back tested data, I ought to have gotten in at VAL. VAL is the volume area low. It's often considered like the cheapest um, price range within the volume profile. So this side is tagged too expensive. Anything towards here, which is the VAH volume area high, is tagged too expensive, and anything around this area is tagged too cheap. So for something for too expensive, you're going to always expect sellers to come in to drive the price down, while for too cheap you're going to expect buyers to come in and defend that area, which is exactly what happened. So if you put a line on it, you would definitely see that that was exactly what happened. You see this was it. It got to this point exactly, as in hitting this exact point, and before just taking off to the upside. So based on my backtested data, I've actually backtested this strategy over a while. I also have used VAL, not POC, for entry. So BTC 15 minutes. I'll show you everything just as the strategy has said it, but I didn't. Impatience. So I'm showing you everything that goes on in real trading, not some influencer um, sim, um, simulated outcome. They don't show you everything that happens. Even if you're an elite trader, I guarantee you would still make mistakes with your strategy. You will still ignore your rules, and you will definitely pay for it. As I would always say, every mistake in trading is very costly. Every single mistake. So every mistake in trading is costly. Every mistake, not some. Every single mistake you make, if you ignore your um, normal entry point, your entry precision model, if you ignore your point of support or resistance, if you ignore whatever is in your strategy, if you ignore it I guarantee you you're going to pay for it in the form of stop loss. And if you don't have a stop loss, your account is going to burn. That's it. So in this series, I'm showing you everything that goes on in the mind of a real trader and everything that happens as you trade. As you trade on a day to day basis, I'm showing you everything that happens in real time. How you could sometimes ignore your strategy, how you could sometimes not follow your strategy, and at the end of the day, you pay for it. So I'm showing you everything. I'm not trying to, because a lot of traders have pushed a very false narrative about trading. So imagine I was trading this and you're seeing wins, 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 wins. Then you're like, whoa, as in trading is easy, it's so simple. It's not. You could have developed the most, you know, the best model, the best entry model, the best entry method or strategy, but if you don't follow it, it's useless. And that's trading. You could develop it and not follow it. And that's the mystery. You would develop an amazing system, a system that is able to get you into a trade and you make a lot, but you just won't follow it and you won't know why. So, welcome to real trading. So, um, I've updated this on the tracker. So, these are the trades. So even when I finally could have gotten in, I couldn't get in anymore because I've hit my maximum stop loss for the day, which is about $8, $8 ish, around $8. So $8 50, $8 60. So I've hit that. So I couldn't do anything anymore. I could only just watch as the trade just took off. Nothing to do anymore. So this is asset class long position 77 210.70. Stop loss was 76846 and position size is 0.0123 and it ended as a loss minus 4.48. The other two ended as a loss too, which is sad. We could have made a loss as high as $32 if we had just used the volume area low as our entry, which I have back tested so many times, but for some reasons I just felt like okay, um, POC, point of control, would be okay. Point of control is actually the price where most of the volume was traded, or the volume. How do I describe that? Okay, yeah, the price where most of the volume was traded. That's the point of control. So that's the price point where most of the volume was transacted. So our win rate has dropped. Average win size is 3.98. Average loss size is 4.40. Our win to loss ratio is 0.90x, and we're down $5. Yeah, our account is $500, so no cause for alarm yet. So, but it's just a reminder to always follow your strategy no matter what. So it's better you do not get an entry. It's better price doesn't come to the area you wanted than for you to be in a rush and at the end of the day you hit stop loss and the trade just takes off. So it happens to everybody. So I just want you to be much more aware of it. Just like yesterday, I said the only thing anybody should do is to take a long position. So it was just the exact entry that was the issue, and the reason the entry was the issue was because the leverage is quite high, it's 10x. So your stop loss is going to be a little closer to current price. It's you're not going to have a lot of room to make mistakes, so you just have to make sure that you nail the entry to the almost to the tick. So you nail it within $4, which was what we're trading with, so that we don't hit stop loss. Stop loss is around 4.45 ish. So yeah, around 4.48. So you need to nail your precision entry within that stop loss range of 0 to, let's say, $4 at most. So anything beyond that, you're going to hit stop loss. So yeah, so today I want to show you my strategy. Why am I showing you? Because I know a lot of people won't use it. I also know that some people will take something from it and ignore the rest, and some people would not use it at all. Some people will skip it. So at the end of the day, it won't matter even if I show you. So that's it. Some people pick something out of it, maybe something they've always missed in their trading, and they're like, oh, maybe this is the reason why I've not been getting it right. So could pick something. Some people could use the entire framework. So whatever. So the strategy is simple. It uses all of the elements. It starts with a trend, then a bias, then structure, then entry framework. I'll teach everything in each of the coming days. So first we'll go with trends, which is tomorrow market structure plus trends. Then the next day the structural bias and how it works, and then support and resistance, how it works. A lot of people don't understand that. And then the entry model, AOV. So this is a repeatable read on trend, check who is excited, check the structure, entry in all four components. So the M for the strategy is market plus trend. The X1 is structural bias, which is derived off of the MACD histogram. The next is support and resistance, depending on the time frame you trade. If you're a day trader, recommend you use the 2 hours support. If you're a swing trader, you should use the 4 hour support. Then EOV, which is the entry support setup. I'll show you what this is about. EOV stands for engulfing, unmitigated engulfing, or unmitigated order block using the fixed range volume profile. So we'll get to this. The very first is the framework, four components, read top to bottom. So let's see if we could increase this. Okay. Okay. So this is all four components. Read top to bottom. M is market structure. You need to first of all determine the trend. That's why yesterday I said the only position we could take was to go long, and that was exactly what we did. It was just the exact entry that was the issue, of which the entry has been modeled for. I just did not use it, which was a mistake on my own part, but this is real life. So, market structure, M is for market structure, and M is just M, which is market structure. Or if you don't want to use the typical market structure mapping, you use the 200 EMA. So you use the 200 EMA if you don't want to mark it out using market structure. I'll show you how to do market structure tomorrow. And one of the things, or most the things people miss a lot with market structure, a lot of people miss it a lot, and there are actually two guidelines that I use. I'll show you. So market structure, if you want to map it out using market structure, that's the very first thing you have to do. What trend are we? Are we in an uptrend or are we in a downtrend? So you have to, like this um, BTC, what trend are we? This is an uptrend, clearly. This is an uptrend. We'll switch it to the 1 hour time frame. This is an uptrend. So the very first is market structure M. You could do that either marking it out using regular lines or the part 2. I'll show you. This is the part 2. You could use it to map out market structure like that. That's so that's the tool. That's what most people use to mark out market structure. So, or you use the 200 EMA. If you don't feel like stressing yourself using market structure, maybe you feel I don't have the time to have to do higher high and higher low and lower high and lower lows. I don't have time. I don't want to mark that out. I'm short on time, or I just want to get into my trade quick, but I just really need to know who's in charge. So you use the 200 EMA. This is it, 200 EMA, and you will just see who's in charge. This is an uptrend. Clearly, you could see prices above the 200 EMA. So when you first add the EMA to your chart, it won't have the length as 200. Just set it to 200 and click on OK. But when you delete it, it will go back to the default. So what you do is you click on settings, this settings, then you change the length to 200, then you click on default, and you would click on save as default, and then you click OK. So anytime you put it on your chart, it will be 200 EMA by default. So this is clearly an uptrend, and what do you do in an uptrend? Long positions only. So that's the very first component of the strategy. The next is structural bias, and it uses the MACD histogram alignment across 15 minutes time frame, 1 hour time frame, and 4 hours time frame, plus whether the previous day's point of control price using section volume profile is above or below price. I'll show you what that means. So this is it. So you click on this, you add the structural bias, and I will explain each of the components to you. What's happening? Okay. So this is the structural bias indicator. It uses the MACD histogram. So the 15 minutes MACD histogram is bearish. The 1 hour MACD histogram is bullish. The 4 hours is bearish. This is the previous day's POC, which is point of control. Which price was volume traded the most the previous day, because that previous day is completed, so the volume for that day is confirmed, it doesn't change anymore. So where was that day's most traded volume? At what price was the most traded volume? So, and today we're comparing it to today to see if price is above or below it. For this case, previous day's POC, price above POC. You could see that what is the exact price of yesterday's POC, which is 77,193.2. And then we also consider the DXY. The DXY is the dollar index, which has an inverse relationship with Bitcoin. So if DXY is going up, Bitcoin is going down. If Bitcoin is going up, DXY is going down. So they have an inverse relationship, but sometimes they used to go their separate ways. Within a short while, they could diverge from each other and then converge back again. So it checks for 1 hour DXY because this was built for day trading. I'll say this again, this particular indicator was built for day trading. I also have the one for swing trading, which is structural bias swing trading. It uses a different parameter. So this is for day trading. So the 1 hour DXY is bullish. So it will give you structural bias not defined. So it's not defined. It has about 8 unique structural biases encoded within it. So because this particular condition doesn't meet any of the encoded structural biases, it will tell you not defined. For final signal, it will tell you no trade. So what was the last aggressive signal? Because it uses two signal types, the aggressive long and aggressive short. So it's telling us that the last signal that was printed was bearish aggressive, and it was printed 24th August 2026 at 9 a.m. So if we look at this, if we want to look at this, and I told you guys that if it prints an aggressive signal, then it definitely means that if it's an uptrend and it prints an aggressive a bearish aggressive signal, it means that it's a corrective wave in an uptrend, a correction, because in an uptrend you have a move up, then a correction, then a move up, then a correction. So that's the corrective move that is giving you the bearish aggressive. So if we look at this, 24th, we had 24th. Okay, we had 24th, around 9, printed a bearish aggressive, and because this is against the trend, most times you have to be careful with it, because most of the times you're taking a bearish aggressive in an uptrend. Most times it may not work because it's counter trend trading, but sometimes it will work and produce a little profit. So you just have to keep that in mind. Just like I've said, the trend always wins. The dominant trend always wins. So you just have to keep that in mind. So like this was printed 24th, at around at 9 a.m., which is today. So but at the end of the day, then we saw a move to the upside. Why? Because it's against the trend. Sometimes it works, sometimes it does work. I took a short position. This particular short position that gave us a 6 boss profit was when the MACD histogram or structural bias indicator sent me a notification for aggressive short. So I took it, looking at the conditions, and it was valid. It was a corrective wave in an uptrend, and I just got in. I wasn't expecting much. It went as high as 18 bucks, but I was waiting for it to go further down so that I can take more profits. But unfortunately, when I saw it that it's as if this thing is not going further because it's against the trend, it's just a short correction in the main trend, I just had to close it. So it works sometimes, it doesn't work sometimes. So the next is support and resistance. Why support and resistance? I'll show you. You have to look at key levels. If you're day trading, you use the 2 hour support and resistance. If you're swing trading, you use the 4 hours support and resistance. The 4 hours support and resistance is often the strongest. You can also use it for day trading, but oftentimes the 2 hours support and resistance is the right balance. Then the entry is EOV, which is the nearest unmitigated engulfing candle or other block anchored to swing high or swing low using a fixed range volume profile. So each of these components answers a specific question, which is very important. What is the trend? It's answered by M, the very first M. The M gives you market structure and the 200 EMA, or market structure or the 200 EMA, and you use it 1 hour for day trading, 4 hours for swing trading. So if you want to answer the question, you open a chart. Let's say we open this chart. We ask ourselves, what trend is this? The first thing, what tells us that is M. What is the trend? So we could either map this out using market structure, or we use the 200 EMA. Question answered. The next is, who is more aggressive in this trend? So which we use X1 for that, structural bias. So we're asking ourselves that, okay, fine, we know this is an uptrend, but are buyers super excited in this uptrend, or they are beginning to get tired? So if you see that the 15 minutes MACD histogram is bullish, 1 hour is bullish, 4 hours is bullish, price is above the previous day's POC, then the DXY is bearish. That means that buyers are super excited for this risky asset, which is Bitcoin. So they are super excited, and they are likely going to drive price crazy, as in they are going to be insane in moving price to the upside, because they are super excited, they are pumped. That's the right word, they are pumped. So you're going to see massive price movement based on the fact that they are pumped. and they are excited. Same thing in a um, in a downtrend or a bearish trend, and you see that the 15 minutes MACD is bearish, 1 hour is bearish, 4 hours is bearish, price is below POC, and then the DXY is um, is bullish, then it will print structural bias bearish, final signal bearish aggressive. So in a downtrend, that's to tell you that sellers are in hyper mode. Most likely they are in panic mode. They want to quickly, sell off their position so that they don't take more losses. So everybody is just excitement. We call seller zone excitement, or we just call it panic. Yeah, that's the right word. For buyers, it is excitement. For sellers, it is panic. So then the next question, after you found out what trend is this, uptrend, are buyers excited, all the MACD lines up, structural bias gives us bullish, final signal bullish aggressive. Then we then ask another question, is there a major support level standing against us? Then we check 2 hours support level if we're day trading, because you want to be careful that you don't go long if there is a resistance, a strong resistance above you, so that it doesn't hinder the move and the trend doesn't just reverse. You get, so you have to ensure that there is nothing standing in front that could be a hindrance to the movement. That's what S2 is for. So is there a major support level standing against us? And then there's EOV. Where do we enter? EOV is the nearest unmitigated engulfing candle splash order block to swing high or low using the fixed range volume profile. So if you want to find out what the trend is, you use market structure or 200 EMA. Two ways to read it. If you want to, who is more aggressive? So once trend direction is set, S1 measures which side, bull or bears, is pushing harder right now. So all of the MACD has to align 15 minutes, 1 hour, 4 hours, aligned direction across all three time frames. Price versus previous day's POC. Price holding above the previous day's point of control supports a bullish bias. Holding below supports a bearish one. Bias confirmed when MACD alignment and POC positioning agree. Then, is there a major level in our way? So before committing to a level or direction, check whether a higher time frame level stands against the move. So if your entry is 15 minutes, which is your entry time frame, you want to check 2 hours and see if there is a major, if you're going long, you want to check if there's a major resistance above. If you're going short, you want to check if there's a major support below. Why this matters: every confirmed trend and bias can stall at a strong 2 hour or 4 hour level. S2 is the check that keeps M1 and S1 honest before you commit to an entry plan. So you want to see if there's something that could stop the move. And then where do we enter? So engulfing candle splash order block, swing high or low via fixed range volume profile. One filter keeps it mechanical. So first of all, find the candidate, locate an engulfing candle splash order block that remains unmitigated. Unmitigated means price has not broken below it. We filter it by proximity, which is closest. Keep only the one closest to current price. Price must reach it first. Then you anchor the fixed range volume profile, run the fixed range volume profile from that candle to the swing high, bullish to the swing high, bullish or swing low for bearish. If you're going bearish, if you're going bullish, you anchor it to the swing high. If you're going bullish, you anchor it to the swing high. If you are going bearish, you anchor it to the swing low. Enter at a value. Then it says plan entry at the resulting POC or VAL for long, or POC and VAH for short. So that was exactly what we did here. We entered at POC, but the truth was the leverage is too much, which is 10x, meaning that um, the the space for us to actually get it wrong was it was kind of too short or too small. So on a normal day, we would have used the VLL. If we had used the VLL, then we would have had more room to breathe and probably would have been up almost 30 bucks at the moment. So you see, so we kept it to proximity so that it's easily backtestable. So if the nearest level fails, step to the next unmitigated one. Don't cherry pick out of order. So you get, so you have to, every of this rule was built to be mechanical. Every of this rule was built to be mechanical. I had to remove literally every subjectivity from this strategy. So I had to remove anything that you had to guess, or anything that you had to do by yourself, or anything that you have to think by yourself. No, everything is mechanically based. It follows a defined pattern that you can just look at and then you could just implement it without having to think about it. No subjectivity in this strategy. Everything is mechanically based that uses a defined rule or defined rules. So for BTC, we use the 15 minutes time frame for entries because it is a volatile asset. We don't want to use 3 minutes. Normally, I use 3 minutes for Forex, but for BTC, I use 15 minutes because it's a much more volatile asset. So, and it tends to respect a little bit of it kind of respects time frame that are more richer compared to time frames that are more noisier. 3 minutes is definitely more noisier than 15 minutes. So the BTC tends to respect a much more, should I say, will I say a much more standardized time frame, or should I call it a much more a time frame that a lot of traders use. Let's use that word, a much more popular time frame. That's the right word to use. So I've shown you everything all about this strategy. This strategy had really um, done well for me. It's just the only challenges I've had with it sometimes is me not following it completely like today. But we'll be back. Definitely, if I see a trade that is worth it, then I'm definitely going to take it and then update it here. So currently, there's no cause for alarm. We're just $5 behind. So definitely, we should get this back in profit and just be able to scale it further to the upside. So everything looks good. Um, from the look of things, we would. I'm still looking at the moment. Everything still suggests um, that bullish move is on, although we've kind of stood as this support area which is heading into the 80k region because there is a lot of orders in the 80k area, a lot of liquidation in that area. So if we should get into the 80k, we'll likely witness something called cascading effect, meaning most of the short positions gets liquidated, which triggers price to move to the upside because as they are being closed, they have to go long in order to close because they were originally short positions. So